We're going to shift now to a piece of interesting research that we just have published that Kathy will talk about.
Great, thank you, George. We just published a report called Advisor Preferences by Investor Profiles. Now that's a really exciting and catchy title, we know, but we're trying to be very descriptive about what it is. And what this report is about is, are there do different types of people automatically choose different types of advisors? Are there certain kinds of investors that will always automatically go to a financial for example, a financial planner versus those who are going to go to somebody who's an investment manager versus those who might go to an online broker. And some of those are more obvious than others. But we thought that it would be interesting to look at people and how they chose the advisors that they had chosen, and were there certain similarities about those different types of investors. So we looked through our whole year's worth of research. So roughly we'd have more than 3,500 households that we had interviewed over the last year, that we looked at who they chose and then tried to cluster them into groups of what were interesting facts or interesting trends that we found about those different types of individuals. This would include households that had $100,000 of net worth up to $25 million. And then we would have taken those and made sure that we had the appropriate segmentation in each group. So if you want to take a look at page 15, the first thing that we wanted to introduce to you is the fact that there are different advisor types used by wealth segment. So the top advisor types in each of the different wealth segments that we generally look at are published here. So you can see the full service broker in all three segments is the most popular type of investment advisor. And then in the mass affluent, the independent financial planner is second, compared to the online broker and the ultra high net worth, which you say, what is that about? And a lot of that has to do with some of the tendency of some of the younger, very wealthy households to try to kind of be sort of self-directed. You'll also see in the ultra high net worth, those are with more than $5 million, an accountant often shows up as one of the most important advisors. And that's because a lot of these people will be business owners. And so they would depend upon their accountant for everything. The other thing that's an interesting one to look at is if you take a look at the mass affluent and you see that the banker comes in number 3. What's important is that bankers, for a lot of these people, especially mass affluent, you'll have younger households. They're people who put their money in the bank. They're just starting to get enough assets to really think about what it is that they really want to do with it. And they're great opportunity for banks to be able to reach out and start to take care of these households, even though they haven't always been successful at doing that. So those are the types of different kinds of individuals we looked at. We sorted them by what different types of advisors they were using. So if you take a look at page 16, one of the things that we ask all the time is your financial situation today better than it was a year ago? If you take a look at this, the people who have a mutual fund company represented as their primary advisor, they're the ones that are happier about their financial situation, which is kind of interesting. You would hope that it would have been the more full-service brokers who had the happiest clients, but they kind of fall in there at one of the lower percentages. Those with a banker as their primary advisor are less happy than some of the others, and independent financial planners are happier, and discount online brokers. So it seems like a lot of these people that are kind of do-it-yourselfers are feeling kind of good about the way that their investments are going, as opposed to those who are more reliant upon advisors.
Short question from the audience. Define the 3 wealth segments for folks.
Oh, sure. Mass affluent is households with $100,000 to $1 million of net worth. Millionaires are $1 million to $5 million of net worth, and ultra high net worth are those with $5 million to $25 million. Thanks. Page 17 goes into a little more in depth into what this report really will tell you if you should happen to want to look more into it. So, for example, we pulled out one of the segments of people who are using independent financial planners as their primary advisor. So what is that we find out about them? Well, for example, a lot of them are baby boomers, 70%. Only a very small percentage of millennials are actually looking at them, but 12% of Gen Xers are looking at financial planners, which is an interesting kind of finding, because Gen Xers are people who sometimes haven't chosen an advisor yet and are really a prime age group that advisors should be targeting. You can see that 61% are males, and the working retired is about equal for those who are using independent financial planners. People who use an independent financial planner are fairly knowledgeable, but feel like they have a lot to learn. Some of them think they're very knowledgeable, but compared to some of the other segments, they kind of fall more into the upper confident category, but not overly confident category. These people will talk to their advisor about almost half of their assets, and they'll control about 25% on their own, and then they'll turn another quarter entirely over to a professional advisor and say, take care of this for me. The 25% that they tend to control on their own oftentimes may be in a separate online brokerage account, or it may be the things that they're investing in that may be things like real estate or those types of investments. Or because we're including all the way up to 25 million, it could in some cases be, private equity types of investments. So that's the kind of information this report will give to you if you're interested in pursuing it.
One of the things that is in the report that Kathy touched on briefly was the number of folks that are using banks, younger people in particular. In the last couple of years, we've noticed in our research that it's always been quite easy to stereotype millennials and Generation X investors don't have money yet, and a number of them don't. But there is a pretty significant group of millennials and Generation X who are just as wealthy as the older folks in each of these wealth segments.
Correct.
Meaning, if you think of ultra high net worth, which is 5 to 25 million, there's the same percentage of younger investors who are worth 5 to 25 million as folks who are World War II and baby boomer in terms of market size. And so it's been quite easy for the advisor and provider industry to ignore the younger investors or assume they're all going to use robo-advisors. The other thing, as Kathy said, younger folks, because of the relationships that they've had with banks, it's a prime opportunity for those of you that are in the bank world to hold on to these clients. And because historically, we would see that younger investors would leave banks around the age 30 and shift to different types of advisory firms. And yet all the banks have the capabilities that everybody else has these days. So the opportunity is pretty significant as money is beginning to actually shift. Everybody talks about the multi-generational wealth transfer. We actually are starting to see it in Generation X and millennials for the first time, where money is actually now in their families as opposed to their parents or grandparents.
So if you have any interest in this report, just let us know. It's less, I think it's $795. It's not as expensive as some of the others. And it can help, it gives you tips on if there are different types of, there are things you can do to attract individuals who are already at a different type of advisor to whatever type of advisor you might be. The last thing I wanted to touch on is we have our High Net Worth Insights newsletter that you can always request a copy of it from us. And it's an annual subscription, $245 a year. It gives you a lot of information every month, some in-depth information about some of the research that we're doing. And for example, the table of contents is on page 19, and one is about joint decision making, one's about age, working with female investors. Those are the types of articles that we have. So you will receive an email following this where you will be able to download, I think, a copy of this webcast, as well as you will have access to any of the information that was available here today. And if you have any questions, please feel free to follow up with us. Anything else you want to add?
Oh, thank you very much.
Thanks. Have a great day.